All right, today we're tackling one of the wildest, most mind-bending concepts in all of decentralized finance, the flash loan. Seriously, this is a financial tool that just seems to break all the rules of borrowing and lending. So let me just ask you this straight up. What if you could borrow, say, $200 million with zero collateral, no credit check, no assets to your name, nothing? Sounds completely insane, right? Well, in the world of DeFi, this isn't just possible. It happens all day, every day. You know, a Reddit user really hit the nail on the head, calling it a mind-bending way to borrow unlimited amounts of money with no risk. It just doesn't feel like it should work. Unlimited capital, zero risk to the lender? How on earth is that even possible? Well, the secret isn't some clever financial trick or a shady loophole. Nope, it's a fundamental feature baked right into the core technology of the blockchain itself. Let's dig into how this works. The whole thing hinges on a concept called atomicity. Now, that sounds technical, but the idea is simple. Think of a single blockchain transaction as a little package. Inside that package, you can stuff a whole bunch of different actions. Atomicity is the golden rule that says everything in that package must succeed. If even one tiny little part fails, the entire package is thrown out. Poof! It's as if none of it ever happened. So a flash loan is basically a set of instructions you put inside one of these atomic packages. And it has 3 steps that have to happen, boom, 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 almost instantaneously. Step 1, you borrow the funds. Step 2, you immediately use those funds to do whatever you plan to do, like making some trades. And step 3, you have to repay the full loan plus a tiny fee. All of this has to happen before that transaction package is sealed and delivered. And here is the magic trick. This is the all-or-nothing guarantee. If your strategy in step 2 doesn't make enough profit to repay the loan in step 3, the entire thing fails. The transaction is just erased. The money zaps right back into the lender's pool like it was never gone. For the lender, it's a loan with literally zero chance of default. Someone on Reddit came up with the perfect name for this, and I love it. It's Schrodinger's loan. While that transaction is being processed, the loan kind of exists and doesn't exist at the same time. If you turn a profit and pay it back, the loan becomes real. If you can't pay it back, it retroactively never even existed. The only thing you lose is the small network fee for trying. Okay, so what we have here is this unbelievably powerful, nearly risk-free way to access huge amounts of money in an instant. But, like any powerful tool, whether it's good or bad really depends on who's using it and why. And this power really does have 2 completely different faces. On one side, flash loans are incredible tools for things like arbitrage and collateral swaps, which actually make the whole DeFi market healthier and more efficient. But on the other side, they can be used as devastating weapons for manipulating prices and exploiting weaknesses in other protocols. Let's start with the good stuff. The most common positive use is something called arbitrage. So just imagine a crypto token costs $1 on one exchange, but $1.01 on another. An arbitrager can use a flash loan to borrow millions, buy the token on the cheap exchange, sell it on the expensive one, repay the loan, and pocket the difference. This actually helps keep prices consistent across the market. It's a win-win. Another really clever use is for collateral swaps. Let's say you have a loan on one DeFi platform, but you see another one offering way better interest rates. Normally, you'd have to find the cash to pay off that first loan to get your collateral back before you could move. With a flash loan? Nope. You can borrow the money, pay off the old loan, move your collateral, take out the new, better loan, and repay the flash loan, all in one single seamless move. It's brilliant. Okay, but now let's talk about the dark side. Because flash loans give people temporary financial superpowers, they can also be used to amplify attacks in terrifying ways. And the first really big wake-up call for the DeFi world was the attack on the BZX protocol. So back in 2020, an attacker took out a massive flash loan. They used that huge pile of money to temporarily manipulate the price of a token on a decentralized exchange. That weird artificial price then let them exploit a logic bug that already existed in BZX's code. And this is the part that's so important to get. The flash loan itself wasn't the weapon. It was the key that unlocked the door to an existing vulnerability and let the attacker strike at a massive scale, walking away with over $370,000. So who are the people actually using these wild financial tools, and where are they getting them? Let's take a quick look at the ecosystem that's popped up around flash loans. Now, a few different protocols offer flash loans, but honestly, there's one name that just dominates the space: Aave. They were the ones who really pioneered this tech back in 2020, and today they control something like 60 to 62% of the entire DeFi lending market. Of course, you've got other big players too, like Compound and MakerDAO. And what about the borrowers? Well, this isn't exactly a game for your average crypto enthusiast. The folks using these are highly sophisticated developers, and more often than not, automated bot farms. We're talking about complex algorithms that are scanning the blockchain 24/7, looking for those tiny, fleeting price differences or a crack in some protocol's armor. For any Flash Loan user, the main tool of the trade is a custom smart contract. This is the piece of code that basically lays out the entire battle plan. Borrowed from Aave here, swap on this exchange, sell on that one, and repay Aave. It sounds super complex, but a lot of this stuff is actually open source. You can go on sites like GitHub right now and find examples to learn from. And to actually pull one of these off, you need a whole toolkit. It all starts with that smart contract. That's the brains of the operation. Then you need other tools to talk to the blockchain and to feed your contract real-time price data. And look, if you're playing with millions of dollars, you absolutely need to get your code audited for security, and you need to be smart about optimizing your transaction fees so they don't eat up all your potential profit. The thing is, flash loans are out of the bottle now. You can't uninvent them. So the really big question is, what's next? Are we going to see them unlock amazing new financial innovations? Or are we going to see regulators try to step in and tame this beast? Well, the innovators are already dreaming bigger than just crypto trading. I mean, just imagine using a flash loan to buy a house instantly, completely skipping the months-long mortgage process. Or think about an insurance company using one to pay out a massive claim in a disaster area instantly. These are some seriously powerful ideas that could make old-school finance way, way more efficient. But as you'd expect, with this much power and potential for disruption, the people in charge are starting to notice. Global financial authorities have their eyes on this space, and they are watching very, very closely. The Financial Stability Board put its finger on the core fear. They see that DeFi is basically rebuilding the traditional finance system, or TradFi, from the ground up. The big worry for them is what happens when these two worlds get more connected. Could a big hack or a crisis in the wild west of DeFi actually spill over and cause real problems for the traditional global economy? And that really brings us back to the central question, the paradox of this whole thing. Are flash loans a revolutionary feature, a brand new building block for a faster, more open financial future? Or are they a bug, a tool that's just so powerful that the risk of it being used for mayhem will always outweigh the good it can do? That's the billion-dollar question we're left with.